Hello, we are live. Hi, I'm Mitch Goldberg. Today we're talking about how to speculate like a pro. Now, we have a couple of things to cover here because speculation, it's almost like a dirty word on Wall Street. It's a dirty word anywhere for investors, right? But it really shouldn't be. First of all, there's many definitions of speculation. You can ask three people what their definition is of speculation, and you could actually get three different answers. I want to talk to you a little bit about what speculation is. Could it be right for you? Most likely. Well, for most people, the answer I think is no. Okay. Now, I'm a financial advisor. I'm Mitch Goldberg. I am owner of a investment firm called Client First Strategy. And one of the things that I do as a financial advisor is I guide my clients through personal finance and investing. And I don't want to just come out here with the same, generic, boring advice that other financial advisors give because I don't think one size fits all. So we're going to talk about speculation, what it means, how it works, and if you're doing it right, because there's a lot going on with GameStop, price of silver going up, crypto. There are so many things going on. And what you really want to know is, should you get into these? If you're already in them, should you get into them more? Should you get out of them? And there's just a lot of unanswered questions because so much of what's going on now is so new. But I've been at this for over 30 years. I know a thing or two about strategy, speculation, which is just a small part of the overall investing picture. So before someone says, oh, you're a financial advisor, you can't talk about speculation. Listen, I'm a financial advisor. I can talk about speculation because I think for the right person, it's not necessarily a bad thing. And for the right person, it could be a good thing. And for some people, it might even be fun. So let's quickly roll the intro and we're going to get into this. And my goal is for you to walk away with a couple of strategies or ideas that could help you, A, decide if you want to speculate, and B, how you could possibly go about it. So here we go. Okay, we're back. Thank you so much for joining me. Your time is valuable, and I greatly appreciate that you decided to spend some of it with me. The goal here on my live stream, it's called Be the Boss of Your Money, powered by Client First Strategy, the name of my investment firm. The goal here is to educate about personal finance, investing tips, that sort of thing, and to basically make you smarter about your financial decisions so you could be the boss of your money, not you become the boss of your money. It's very easy for your money to become the boss of you. Did I say that right? So you could be the boss of your money, not your money to become the boss of you. Okay, so just want to make sure I said that right. So first, let's just take a quick look. We're going to go through this pretty quickly, but let's do just a quick rundown of the day. Last week was the worst week since last October. I wouldn't say this was a resounding high and rebound, but nonetheless, major averages pulled through a little bit, gave us some of the losses back from last week. So the Dow is up a little bit. Not a bad day, though. S&P up over 1%, NASDAQ up over 2.5%, work from home, stay-at-home stocks working out. And the Russell 2000 was up pretty big. And Russell 2000 is important because it's smaller companies. That's the Russell 2000 is the main measure of small cap stocks. It's an index. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So when the Russell 2000 goes up, that's a little bit more optimistic on the economy, things like that. And the VIX is still slightly above 30, the fear gauge. We'd like to see that go down to maybe 25 or so for a little bit more comfort level. How about that? Okay. And let's talk about speculation. So there's a lot to say about speculation. Is it a terrible thing? Because I'm in a community of financial advisors, and a lot of my fellow financial advisors are comfortable with speculation. And okay, let me just make sure I'm on the main camera. And a lot of financial advisors are not comfortable with it, and a lot of clients are, and some of you might not even be using a financial advisor. That's okay. The show is for everybody. how do you define speculation? Some people think speculation is just buying a stock, buying an individual stock. Some people think putting money into a diversified mutual fund or an S&P 500 index fund is speculation, because you don't really know what's going to happen, right? So there's different definitions, and some people feel that buying an individual stock is speculation, and some people feel that buying a small cap stock, a small company, a small biotech company, for example, is speculation. So what I want to do is define speculation, meaning buying securities that you're buying solely because they're going up for reasons other than the expected improvement in fundamentals. When you buy a stock, no matter how good their fundamentals are, their earnings and revenues could be wonderful, could be great. But no matter what, if you buy a stock, it's because you expect their future earnings and revenues to be even better. But if you buy a stock or any security, well, I think in this case, we want to talk about mostly stocks. If there's no fundamental reason for the stock to go up and it's just going up, for example, like GameStop or AMC, and they're being spoken of, in online chat rooms and WallStreetBets community and Reddit, that is speculation. These companies are no more financially sound today than they were 2 weeks ago. And that's something that you have to take a look at. And that's what I mean by speculation. There's other kinds of speculation. Let's say there's a biotech stock. They've got a couple of new drugs in the pipeline, let's say for COVID, right? And let's say that company is called Moderna, and it's $10 or $20 a share, and now it's what, 140, 150. I didn't take a look at where it is today, but the point is that's in a way that's a speculation, because what if they didn't get FDA approval for their drug? What if their COVID vaccine didn't work? So there's various kinds of speculation. And if you're buying a stock for a short-term move, let's say you're buying Google or Amazon because you expect them to report a blowout earnings number and you expect the stock to go up a lot the next day, to pop. Well, then you're just speculating on earnings over the short term. So there's a few ways to measure speculation, but I think what's important is you have to define the right definition of speculation for you. By the way, if you're watching this right now in the live stream, and if you have a question, hit me up in the comments. Your words of wisdom, words of encouragement are always appreciated. Right now, there is a pretty heavy-duty snowstorm going on Long Island in my neck of the woods. So the lights have flickered a couple of times today. So hopefully we won't lose the stream today. If you're watching this in the replay, welcome to you as well. And certainly hit me up with your questions in the comments. I'll check. I'll keep looking for those. I'd love to have a shot to answer your questions. So who is speculation for? Speculation is for people who can afford to take the risk. Okay, so that's a given. So if you're 30, 40, 20, even 50, hey, I'm in the 50 plus crowd, so I'm not making fun of anyone here. So what you need to look at is if you're suitable for speculation. Just because you have a lot of money and you make a good living and you're socking away money at a fairly young age doesn't mean that you have a high risk tolerance. So risk tolerance is your threshold for pain. It's how much risk you're willing to take with your investments. Some people are willing to go 100% in stocks in all of their investments in their 401k plan, for example, but they'll do it with mutual funds or exchange traded funds. Some people want to go into a sector fund, like just a fund that just invests in drug stocks or just technology stocks. And that's definitely a little bit more aggressive than buying a broadly diversified fund like the S&P 500, which diversifies across all the major sectors of the economy. Even though right now the S&P 500 is very heavily skewed toward a fistful of stocks like Facebook, Amazon, Apple, Google, Netflix, Microsoft, even Tesla now, okay? So there's different degrees. Who is it for? When I think of speculation, I think of buying, investing in a company that's pie in the sky. They may or may not come out with a certain product that you expect them to come out, like a biotech stock. And then you take a look at what's happening with GameStop. And I think that's really speculative. In my opinion, that's my opinion. It's really speculative. AMC, the short squeeze stocks is what we call them. Now, I'm not knocking someone. Oh, you're speculating. No, if you make money because you speculate, you still made the money. It's yours to keep. You took the risk. You deserve it. You deserve to make the money. If you took a loss, well, I'm not saying you deserve to take a loss. You took the risk. That's what happens as long as you're prepared to take it. I have people sometimes ask me about these stocks. They ask me if they should get into Bitcoin or Ethereum or now Dogecoin. Okay. And what I say to them is make sure you are putting money into these that you could afford to lose. And if you want to put aside if you want to set a strategy, take, for example, hey, 5% of my portfolio, 2%, 15% of my portfolio could be for speculation. If you're younger, you typically will have less money to speculate with. If you're older, you'll typically have more money if you want to speculate, get aggressive, but you have less time to recover. When you're younger, you have more time to make back money you lost. I am all for young people taking a shot. If you believe in Bitcoin, if you believe in the dollar is constantly getting diluted because of all the money printing, and you feel that you want to grab onto something finite, like there's a limited amount of Bitcoin, there's a limited amount, for example, of gold, there's a limited amount of silver. It's just silver and gold are just determined based on small amount of growth, how much, humans can extract from the ground. But keep it to a certain percentage of your portfolio. If you're buying gold and silver because it's your hedge against inflation, and you believe that the Federal Reserve is overdoing it with dollar printing, and other central banks are doing the same thing, and when we come out of this pandemic, out of this recession, and the economy starts to heat up second half of 2021, if you think there's inflation coming, then that would be a reasonable reason to invest in precious metals, to grab something that could do well in the case of of inflation. But if you're going to just buy a stock because it's a short squeeze, because you're reading about it on the message boards, not selling GameStop till 1,000. One said, another one said, I mortgaged this, I mortgaged my parents' house. I don't know if it's true or not, but these are the things that go around. My sinister view of the world is that be careful, because when you're buying, somebody else is selling to you. And I'm not sure if this is a case of people getting together to pump up the stock. Yes, I know there's a short squeeze, and that's the main reason for the rocket ship ride up, and hedge funds who were shorting GameStop got caught off guard, and they're just getting obliterated when the stock went up, and they have to cover their shorts by buying back the stock, and it creates more buying power. But again, GameStop was not being shorted for its financial soundness. It's being shorted because these money managers believe, after doing their own due diligence, that the company is worth a lot less than the price where they shorted it. So what you do is you have to pick a small percentage of your overall portfolio and be disciplined about sticking to that. The problem with speculation is when people speculate and they're right, they make money, it validates some of the wrong things, that they became suddenly smarter from one day to the next, or that they're really good at investing. Look, this has been a really hot market, and a lot of people are trading and new to the market think, wow, this is easy. But usually your results are more of the result of external forces, like if we're in a bull market or a bear market. And I do think a lot of people are enjoying higher returns because they're taking higher risk, but they don't think they're taking higher risk. They just think that they're really good at investing. And investing is a very humbling experience. I've been doing this for over 30 years, and I've been in the hot markets in the past. I've been in the cold markets in the past, and I'm telling you, it could be very humbling when things don't go your way. So what I want you to impress upon you is pick a certain percentage of your portfolio that you could speculate with. The other thing I want to say to you is, when you invest, how many speculative positions when you speculate, do you want to speculate with? Do you want to just take a shot in GameStop and that's the end of it? Or do you think you'll want AMC and Bitcoin and silver and 4 or 5 other stocks? Because if your allotment is, let's say, 5% of your overall portfolio for speculation, and you used it up on one stock, but now you want to buy more different investments and you think you're going to diversify within your speculative bucket, what happens is you wind up having, 15, 20, 30% of your portfolio in speculative positions. And they could very well work. And if they work out, great. If they don't work out, I'm sorry. I don't want to see anybody get hurt. But to me, losing money is not necessarily getting hurt. Losing money is an acceptable it's a calculated risk that's acceptable. You just have to know what your calculation of risk is. And if your risk is that you could take a big loss, but you are so willing to take that big loss because you think you're going to have such a big return, that's your business. You're entitled to do that. More power to you. So one of the ways you could speculate is be willing to take a profit. Be willing to say, I don't, maybe you bought 20 shares of a stock that went up 200-300% quickly, that because of the short squeeze. Maybe you sell 100 shares. Maybe you sell 50 shares. Take something off the table and determine at what price you would buy those shares back, or determine if it starts to go down. Do you start to get worried that, oh no, I'm giving up my gains. Now I'm really upset. I'm really getting mad. Determine if that's you, then just get out. Knowing yourself is the most important thing to know when it comes to being a good long-term investor. I always like to ask, what good is an investment portfolio if you can't stick with it? So having said that, I am a financial advisor. A lot of people think, oh, well, you're just asset allocation. I'll just say, 5 ETFs, large cap, mid cap, small cap, international, and bonds, and that's it. And for a lot of people, that is very suitable. There are also age-based portfolios, target date portfolios. There's all kinds of ways to figure out the right portfolio for you. There are individual stocks, there are exchange-traded funds. There's so many ways to build a portfolio, but there's only one way to build a portfolio that's right for you. A portfolio that meets your goals when you expect your goals to arrive. That to me is what portfolio management is all about. We could talk about beta, we could talk about standard deviations and alpha and Sharpe ratios and many other characteristics of investing in portfolio management. But what you want is a portfolio that will deliver to you your financial goals at the time you want to meet those financial goals. It's a matter of patience. So that's really it. We have a comment out there. Let's see who's out there. We have Ron out there. Hey, Ron, audio level keeps jumping because you keep leaning directly into the mic's proximity zone when you cough. Lose the headphones for a more natural presentation. Well, I thank you very much, man. Otherwise, video 10, audio 8. I appreciate that. I do have a tendency to get a little too close to the mic. I do like to monitor myself with the headphones, but I hear what you're saying. Thanks, Ron. I appreciate that. Who else is out there? Judy's out there. Stacy, Lori, thank you so much, guys, for joining me. So remember, speculation is not a dirty word. It's really if you want to try it. Maybe this is your Atlantic City or Las Vegas money, and or your poker money, and you just can't get away right now because of the pandemic. So you want to take a shot in the market, and it's fun, and you're playing with a nominal dollar amount that's just enough to be entertainment for you, and you're learning a lot. A friend of mine asked me about her son. Her son just graduated college. He's playing a little bit on Robinhood, and she's worried. And I said, you know what? Her child will learn more from trading on his own in Robinhood, losing, making, than any business class will ever teach him about investing. So I think it's good for hands-on experience, as long as it's a learning experience, not a gambling experience. Okay, so that's my story. I'm sticking with it. I thank you so much for joining me. I'll be back tomorrow. If you have any questions or comments, if you have any questions that you think of after this, certainly hit me up in the comments section, and I will be sure to keep an eye out for that. Thank you so much.